Okay, so yesterday I mentioned to you that JPMorgan Chase is looking for $5,200 on gold. Well, today I'll bring you what Goldman Sachs. Goldman Sachs is sticking to its $4,900 an ounce by year end, and here's why. For the last 3 years, central banks have been the number one force behind the gold rally, but now something new has happened. Western investors are back. We have now two buyers chasing the same bullion. Central banks who are diversifying away from the dollar, and investors who want protection from rate cuts plus currency debasement. This combination is explosive. Central banks buying equal a structural shift. Goldman's estimate is that central banks buying 67 tons per month. That's 4 times faster than before 2022. At the end, it adds 1% to the gold price every month. They expect 80 tons per month through 2026. Why? Number one is the Russia wake-up call. When the West froze Russia reserves in 2022, every emerging market central bank got the message. If our reserves are in dollars, they can be taken. Number two, China is still underweight. The PBOC's gold share is about half the global average. Number three, survey says more buying ahead, record high intentions to increase gold holdings. The bottom line is this isn't tactical, it's a long-term realignment of global reserves. Now let's talk about the West investors that are adding. In 2022 through 2023, investors sold gold because yields were high. Central banks were buying alone, and the price only drifted higher. 2024 through 2025, the Fed starts cutting. The dollar debasement fears rise, and investors begin adding instead of selling. And suddenly, gold that was up 30% in 2024 are hitting new all-time highs in 2025. Now, we have no sellers. We just have two aggressive buyers. The portfolio problem is gold has historically been a small slice of investors' portfolios, only between 2 and 4%. But Goldman shows that based upon risk plus return, the optimal allocation has been somewhere about 5%. Up to 50% of U.S. equities plus 50% gold, especially during inflation and currency debasement time. So even moving from a 2 to 6% gold allocation global would trigger massive demand. And gold is tiny versus stocks and bonds. Small shifts equal big price moves. Upside, not in the forecast yet. Goldman's $4,900 an ounce assumes that the central buying continues and the Fed keeps on cutting. This does not include the large debasement rotation into gold. In their worlds, even a small diversification could be pretty disruptive to gold prices. The translation is that if the dollar continue weakens, then 4,900 an ounce may be a conservative figure. My take is now you have central banks motivated by geopolitical survival, investors motivated by financial survival in a limited supply market that doesn't scale up easily. This is not hype, just do the math.